Are you a CFO new to the nonprofit world? Congratulations. You've entered a very rewarding world focused on making our communities and the world a better place. This transition can seem scary at first, but I hope to make this process a little bit easier for you. We work with some amazing people, and we really care about the people that we serve. In fact, it can be difficult to identify who our customer is because our revenues often do not come from the people that we serve. They come from third-party donors, insurers, government agencies, and parents. It can be difficult to ensure we're paying adequate attention to all of the customers that we serve and those that provide resources to us. Both are very important to our long-term viability. The first thing to understand is that nonprofit is a tax status. It means that as we generate profits, we generally don't pay taxes on those profits because our motive is not to actually generate a profit. It is to reinvest and to do more of our mission and be able to provide more services to those who benefit from our mission. So profits are actually good in our world, and in fact, I encourage them. So the next thing to understand is that we have all of our accounting under FASB, not under GASB, not under government accounting standards. And this is really important because it means that all of the knowledge that you're bringing into the nonprofit world from the for-profit sector is super valuable and important. In fact, 80% of the accounting is exactly the same in the for-profit and the not-for-profit sector. So what I'm going to do is I'm going to focus on just that 20% of where those differences are created and just help you to really understand what to expect and what are the areas that you might want to dig in a little bit deeper and learn more. So what is it that makes us different? Well, the majority of it comes from revenue. In our world, we have 3 types of revenue. The first type is exchange transaction. This is what you're used to in the for-profit. This is where someone gives money or resources in exchange for something of equal value. So no different than what you're used to dealing with. In our world, these could be things like tuition revenue that we charge to students and their families. They're getting an education that's of equal value in exchange. They could be doctors' offices where we're charging a fee for serving a patient and for treating our patients. There's a number of different types of activities that we carry out that are all under exchange transactions. And so the good news is that the way you account for these and thinking about how to measure the revenue and when to recognize the revenue is exactly the same as what you're used to in the for-profit world. So it should be pretty easy to determine the accounting. So the second type of revenue that we have is what's called agency. And I like to think of this one more like a triangle because what happens is someone will give resources to us as the nonprofit organization, but they're not for us. They're specifically to be used for maybe a student that is on our campus. They're specifically to be used for a club or organization. And we have no ability to change who benefits from that money that they're giving us. And so on a college campus, this is very often student clubs and organizations where they will go and raise money for the club and organization, but we hold on to it as the school. And what happens in this instance is it's not our revenue, and therefore it all sits on our balance sheet. We get the money, we record it as a liability, the money is spent, and we reduce the cash and we reduce the liability. But it's never revenue or expense to us because it's not our money. Now, another example of this in higher education or education in general is that the federal government or or third-party entities might give us money specific to pay for someone else's services. So this could come in the form of a grant for a student. It could come in the form of a student loan. It could come in the form of an insurance company paying for medical treatment. And all of these are examples of agency where we have no variance power to be able to spend that money any differently. So while we gave the student or the patient a service and we recognized a receivable and revenue for 100% of the value of that service, when the third party gives us the money to pay for that service, we're simply reducing the receivable, and it does not run through our revenue and expense statement at all. So the third type of revenue is really what gives rise to all of the differences and all of the complexities. And this is what we call contribution revenue. The idea of contribution revenue is it's a one-way exchange. Someone is giving us money and they don't expect anything of value in exchange for it. They just want to support all of the good that we do in the world. And if you think about this in the context of a for-profit organization, wouldn't it be amazing if people would just give us money and not expect anything in exchange for it? But that's really what happens in the nonprofit world. And that is what gives rise to 20% of everything that makes us different. But it also can be quite complex. Now, in the instance of a contribution, someone says that they're going to give us money to support our organization, and we recognize revenue when an unconditional promise to give is made. So this means that when the donor says, I'm going to give you money, that we recognize revenue. And this is because, like an exchange transaction, we recognize revenue when our obligations are substantially met. And because the donor is not expecting anything from us, our obligations are substantially met when that promise is made, and therefore revenue is recognized. Now, there are some nuances to this when it comes to thinking about receivables, pledges, receivables, and also conditional versus unconditional, but we're not going to go into those today. So I want to dig in and help you understand that this is really where all of the complexity in our accounting comes from. Because what happens is a donor may tell us, this money that I'm giving you is to support a specific program or service that you provide. And in that instance, because they're telling us what to use it for, it creates what we call a restriction. And that really is where all of the complexities come in. Now, only contributions give rise to restrictions. I didn't talk about restrictions with agency. I didn't talk about restrictions with exchange transactions, because it is only after you evaluate and determine that it is a contribution type revenue transaction that you then ask, is it restricted or is it unrestricted? Now, it's important to understand that only donor or law can give rise to restriction. So what does this mean? Well, if management or our board decides that they want to set money aside, they may call it restricted, but in fact, it is unrestricted, and we put it in a category that we call board designated. And what that means is that the organization and at the approval of the board can choose to spend that money any way that they want at some point in time in the future, but they've decided to set money aside, and that is perfectly okay. So just be aware that sometimes we'll refer to that as restricted or board restricted, but it really is unrestricted for the purpose of true accounting. So understanding restrictions is really important, because this is really what helps us to understand the concept of liquidity. So what do I mean by that? Well, what happens is we often will have a donor that will give us money and tell us that we can never spend that money. So we can invest that money, and we can use the earnings off that money to support our programs. So let's say, for example, that a donor gives us $1 million and says, you may never spend this money, but you can invest it and use the earnings to support scholarships for students. In this example, the $1 million would be permanently restricted, and the earnings on this money in general would be temporarily restricted for use in scholarships until we actually give out those scholarships. Now, this is important to understand liquidity, because if you received $1 million worth of revenue and you recorded it as revenue, you would want your internally, for you and for the board and for readers of the financial statements, to understand that this money is never available for you to spend, and therefore needs to be accounted for separately. And this really is what creates all of the complexity. It's important to understand that I said in the beginning that only donor or law can restrict money. So what does this mean? Well, in this example, where you have a donor that gives you money that's permanently restricted, there is now a law called UPMIFA, Uniform Prudent Management of Institutional Funds Act, or UPMIFA, that comes into play, and we talk about this as endowment accounting. Now, UPMIFA is different in each state, so it's really important to understand the state that your organization is incorporated in, so that you know that you're following the proper requirements of UPMIFA. But the idea of UPMIFA is it gives us guidance for how to be prudent in how we treat our endowments. And so the idea of prudence is that we need to invest this money in a way that preserves the purchasing power over time. So if you think about $1 million, if you were to invest that in a way that was really risky and could cause that $1 million to drop to $600,000, well, that might not be considered prudent to preserve the purchasing power. Whereas if you were to invest that money in some way that over time earned, let's say, an average of 6%. So you have some years where you earn more, some years where you earn less. Right? The idea is that you're being prudent because you are hopefully preserving the purchasing power over time. Now, this is where spending comes in. So if we were earning 6% on that endowment and we were to say, well, I'm going to spend 6% every year. Well, over time, if you think about 20 years from now and you've spent 100% of what you've earned on that endowment, are you really preserving the purchasing power of that endowment? Because the value of $1 today is not going to have the same purchasing power as $1 20 years from now because of inflation. So in general, what we say is that we need to invest in a way that generates a little bit more than what we would like to spend, so that we can set aside some inflationary factor and grow some portion of restricted investment assets so that that $1 million grows at a rate that is keeping up with inflation over time. Now, this is where legal restrictions come into play, because it is really UPMIFA, not the donor, that's saying that you need to preserve this purchasing power and therefore creating this restriction. Remember, the donor said, you can spend this money on scholarships, or you can spend this money in any way that you want. But UPMIFA is saying, well, you can spend most of it, most of the earnings. And so what happens is that as we invest the $1 million, we then decide if we're earning 5% on average each year, that we're only going to spend 4% or 3%. And so we're spending that 4 or 3% based on the donor's wishes. So it's either unrestricted or it's temporarily restricted for scholarships. And we're keeping the difference between the 6 and the spending, the 4% spending, as temporarily restricted probably for quite a long period of time. Now, I'm not going to go into this in any more detail, but I just think that it's important for you to understand that this is endowment accounting and this can be quite complex. So be sure that if this is significant to your organization, that you understand this over time. Restrictions are what cause our financial statements to look different, right? Again, this is the 20% of, what makes us different. And so when we look at our financial statements, the idea is that donors are giving us money and not expecting anything in exchange for it, and we don't pay taxes on the profits. And therefore, instead of calling it an income statement or a profit and loss statement, we call it a statement of activities. And similarly, with a balance sheet, we often call it a statement of position, though still calling it a balance sheet in our world is also appropriate. But you'll notice that what occurs is that we now have two columns. It's like having two income statements in one, because now we have our traditional unrestricted or without donor restricted column, which has all of our exchange transactions. It has all of our unrestricted donations. And that is showing up in the without donor restriction column. But now we have this other column called with donor restriction. And, I said that this is important from a liquidity perspective, because remember, if you are limited in how you can spend that money and when you can spend that money, it's important to understand that on your financial statements. Now, until a few years ago, this was a 3-column approach. We had unrestricted, temporarily restricted, and permanently restricted. But what happened is we combined the temp restricted and perm restricted columns into this with donor restriction column. And for the purposes of our internal accounting, we are still actually tracking temp restricted and perm restricted separately. So make sure that you understand that even though you only need to present them in a combined column format on your financial statements, they are in fact tracked separately, because if you think about it from the donor's perspective, you need to constantly track over time that you have preserved that $1 million and can never spend it versus the earnings on that money. And this also then does help you to understand liquidity over time, because clearly temporarily restricted money will become available to you to spend at some point in time. If you think about the idea that each time a donor gives us money, and let's say that it's temporarily restricted, this is to be used for scholarships, that revenue goes into the with donor restricted column. And then we actually give out scholarships, and we don't show expenses in the with donor restricted column. So that scholarship or the money that we spend to deliver programs all shows up in expenses on our without donor restricted or unrestricted column. And if you think about that over time, so if a donor is giving us $100,000 and I'm showing it in temp restricted, but I'm recording the expenses in unrestricted, isn't that causing equity or net assets in temp restricted to grow over time? But then in unrestricted, they're constantly declining. And the answer is yes. And that is why we have something called release from restriction. And what release from restriction does is it simply is a revenue reclassification that moves that revenue out of temporarily restricted and into unrestricted as we spend that temporarily restricted money. Now, it's important to understand that just from a behind-the-scenes accounting perspective, many of us do actually record expenses to the temporarily restricted activities in order to be able to effectively track this activity. But what we do at year end for financial statement purposes is we basically move all of those expenses over into the without donor restriction column. And then we also move the revenue by creating a contra revenue and giving a credit to the unrestricted revenue to be able to show the match of that unrestricted revenue and unrestricted expenses, and therefore reducing temp restricted equity. So I hope that is helpful. And there are so many other complexities with accounting for restrictions and when to record the revenue and when to record the release. And we're not going to go into those today, but I will say that my favorite resource is the AICPA Audit and Accounting Guide for Not-for-Profit Organizations. And I generally like this in a paperback format as opposed to electronic because I like to write in it and put sticky notes. And while this is released each year, there generally are not substantial changes in how we account for things. And now there haven't been substantial changes in the past few years. So if you buy the Audit and Accounting Guide, this should last you for several years so that you have the ability to go in and really, dig deeper as issues arise for you when it comes to accounting for contributions and restrictions and financial statement presentations. If you decide that you want more detail, the AICPA also has some really great courses on the detail of not-for-profit accounting on both the revenue and expense side. So now we have talked only about revenue so far, right? And that does cause the vast majority of the differences between the for-profit and the not-for-profit world. But we are going to touch upon expenses just very briefly. So we are required to present our expenses program by program. So if you think about the for-profit world, often we show things like salary, benefits, rent, utilities, and we do track all of those expenses, and we actually create a schedule of functional expenses, but then we show how is it that we spent that money by each one of our major program activities. So if you think about the mission of your organization, you have probably already identified that there are somewhere between 3 and 6 core activities or programs that you are delivering that help you to achieve your mission. And so when you're recording expenses, we have to do cost accounting. We have to basically figure out how much is each one of these activities costing us as an organization. And so if you put your cost accounting hat on, this should be pretty simple. So when we think about how we do cost accounting in our world, I like to think of it as kind of 3 buckets of activity, and we're just going to touch on those a little bit. The first one is direct expenses. So we have salaries that we're paying and benefits associated with it that really relate to a specific program. We may also be paying rent for a building that only houses one of our programs. And in those instances, it's really easy for us to say, I know this cost directly relates to that program. And so often we just record it direct to whichever program that expense was incurred for, and that's great. But we also know from our accounting experience that there are other costs that do directly benefit those programs, but it can be kind of a pain to allocate that cost every time we pay an invoice to one of those specific programs. So this could be something like rent or utilities. Let's say that I have all of my activities within one building and I only pay rent for one location, and therefore I only pay utilities for one location. And so it's kind of a pain for me to think about every time I pay this invoice, I'm allocating it to each one of these programs. Now, you may have accounting software that will allow you to set up those allocations as a default for each one of those vendors. And in that instance, it's great. But if that's not an option for you, what we often do is we make sure that we're aware of what these shared costs are. And then periodically, which might be annually, it might be quarterly, we go in and we just allocate the total costs that were recorded. So we might take all utilities and we might say, 10% of them are for program A and 15% for program B, and so on and so forth. Now, it's important to understand that our third layer, what I call indirect costs or management in general, is an area where we don't allocate cost. So let me explain this a little bit more. If we look at our financial statements, we have each one of our programs listed separately, and then we have a line item called management in general, and we probably also have a line item called fundraising. And so those are areas that are necessary for the organization, but they are not a direct benefit to each one of the programs. And therefore, we have to track costs separately for each one of those areas. So if we take fundraising and management in general as examples, I know when I'm recording salary that I have a dedicated team in my fundraising department, so I'm charging their costs direct to fundraising. And I also know in management in general that for the most part, these are certain costs that we're going to incur as an organization, regardless of what programs we deliver. It doesn't matter that we add programs, subtract programs. We're always going to have a CEO or a president. We're always going to have a finance department. We're always going to have an administrative assistant or receptionist at our entry. And so these are the costs that we say are management in general cost. And therefore, when I am recording payroll and benefits, I'm charging direct costs to my management in general, just like I'm doing to each one of my programs. And similarly, when I'm allocating shared costs, so my building and utilities that benefit the entirety of my organization, I'm also allocating some of those costs to management in general and to fundraising, as well as to each one of my programs. And so therefore, what happens is the expenses that are remaining in that management in general bucket can also be called indirect costs. And this is important, and we'll talk about that in just a moment. So for the most part, what happens with not-for-profit organizations is when I look at that management and general cost as a percentage of my total expenses, it's not unusual that that represents 25% of my total expenses. And in fact, in higher education, this can be upwards of 40% of total expenses. And when I am applying for grants, government grants are a very common one, I'm often saying to the government, please support this program. It costs me $500,000 to deliver. And oh, by the way, there is also a 25% overhead cost on that $500,000. So therefore, I am asking for $625,000, not just $500,000, because I need to cover my indirect expenses. This is important because the biggest mistake that I see a lot of nonprofit organizations make is that they don't understand that these indirect costs exist or how much they are. And what happens is when we apply for those grants, we often just ask for the direct costs associated with running the program, and therefore would ask for $500,000. But yet, it is a reality that our CEO is going to have to be involved administratively. You in the finance department are going to have to do the accounting and the reporting associated with this. So therefore, we should be asking for that management in general fee to be reimbursed. And so this could be called an indirect cost. It could be called an administrative fee. But either way, we want to make sure that we are really covering the full cost of this program and not losing money on it. Now, it is also important to understand that the term indirect costs can mean something very specific in the government grant world, and there are different types of indirect costs. Some of them are pre-negotiated, some of them have to be audited. And so depending upon your organization and the size and the type, just be aware that this can be quite a complex area. And again, we're not going to go into that in any more detail today. We have three types of revenue, right? This is really what makes us different. We have exchange transactions where we're giving something of equal value, and it's just like the for-profit. We have agency where someone gives us resources, but we have no control over who benefits from those resources. They're specifically for another group or an individual, and those are agency. And then the third type is contribution, which is really what causes all the difference for us. And remember, the first step is to determine what type of revenue transaction it is. And only after you determine that it is a contribution transaction do you ever ask, is it restricted? And remember, only donor or law can cause a restriction. Any restrictions made internally by board or management are considered unrestricted, board designated, and you have the ability to choose how you want to spend that money at any point in time with board approval. Now, the other really important factor is that not-for-profit is a tax status. Generating profits is good, and in fact is really important to make sure that we're able to preserve our purchasing power over time and that we're able to continue to deliver the great programs and services that the community relies on us for. So I encourage you to bring that mindset from your for-profit background and make sure that you're really thinking about reinvesting back into the mission and get the organization to stop trying to budget break even, which is what we're often known for, because it is really good to have a little nest egg set aside to be able to grow, reinvest, and create stability during difficult times. So I hope you found this helpful, and I do encourage you to see my other videos on my Making Finance Simple channel, or they can also be found on my website. And just an important note that if you want to sign up for my newsletter, you'll get real-time information regarding some of these brief topics that are specific to nonprofits and higher education. And if in fact you're new to higher education, I also encourage you to check out my video that is targeted towards CFOs new to higher education. And as always, keep doing what you do. We are in a really, really great sector. It feels so good to go to work every day and know that we're making the world a better place. And if you ever have any questions, please feel free to reach out. I'm passionate about what I do, and I'm always happy to help.